Good afternoon and welcome to the Minds and Money Connect conference. I'm delighted to be joined for a fireside chat with Peter Marrone, the Executive Chairman of Yamana Gold Inc. And personally fascinated to hear your views, Peter, and your perspectives on the current gold market and Yamana specifically. So thank you for joining us.
I'm happy to be here. Thank you for the invitation.
Great. Peter, we're currently in the midst of a bull market for gold, driven in part by COVID-19 and the reaction of central banks to the pandemic, but also underlying geopolitical factors with low interest rates globally and increasing global debt. As an industry veteran who's seen previous downturns and upturns, I would be really interested in your view as to how the current market dynamics compare to previous bull markets that you have witnessed, and if there's key similarities and differences between those markets and the current one.
Oh boy. Well, we have a lot of ground to cover, so I'll try to be uncharacteristically brief. We're in the midst of a pandemic, with overwhelmingly negative geopolitical and socioeconomic impacts. We're in a world that is awash in cheap debt, lots of debt, negative yields. We're in the midst of all of that while we're trying to fix social imbalances. We see that in the United States, we see that in Europe, we see that in Canada. There are political forces that are causing disparity, that are causing disputes amongst different peoples. We see that in parts of Asia. And we're printing money, lots of money, $9 trillion in fiscal stimulus worldwide so far. Over $7 trillion in monetary stimulus in the United States alone. And all of that is leading ultimately, in my view, to inflation. Not necessarily a high inflation, but risk of inflation, and risk of inflation going against trend or against expectations. With this sort of uncertainty, volatility, inflation risk in particular, and currency debasement, this is an exceptional time to be invested in gold as insurance. And gold mining companies, in my view, are not yet reflecting the current gold price, let alone what is to come. So this is the perfect storm of converging events that favor the industry. Now, I'm not an advocate for investing in gold alone. I am an advocate for investing in gold, in the gold mining sector, and our company in particular. And that's mostly based on the value proposition. Valuations are at all-time lows, while gold is at high levels and likely increasing.
Thank you, Peter. And obviously there's been a lot of talk in the market about the gold price exceeding the previous market high, which I believe is around $1,900 per ounce. Some obviously speculating as well that it could get as high as $2,000 or $3,000 an ounce. What's your outlook on the gold price in the coming years? And I guess outside of the reasons that you've already mentioned, what gives you confidence that those prices can be sustained for a prolonged period?
Well, a favorite quote of mine that is attributable to Sir John Templeton is the four, and I hope I do justice to the quote, but the four most frightening words in markets are, "This time it's different." And it's never different. Cycles are forever. We appear to be in an uptrend in a cycle. Gold price highs are not, I beg to differ a bit, gold price highs are not $1,900 per ounce. The all-time high for the price of gold, in my view, is $820 per ounce that was reached in 1980. How can $820 be higher than $1,900? Let's remember also that in 1980 and in that period that led to that all-time high, we were in a period of high anxiety, uncertainty, and volatility, very similar to what we see today. If we adjust that $820 per ounce for time and inflation, that means over $2,400 per ounce today. So I should be surprised if a metal whose trading pattern and cycles is over decades would not challenge that all-time high, not 1900, but the adjusted number for the 1980 all-time high.
Okay. And changing tack a little, in the last year or so, we've seen a spate of M&A, particularly in the precious metal space. increased cash flows, reserve replacement, desynchronization, valuation spreads have driven many of these combinations. Do you think that we'll continue to see further corporate deals in the sector? And what do you think are the primary drivers of these combinations?
Well, I think we have to put things in context. The top 15 gold mining companies by market capitalization have a cumulative market capitalization that is smaller than Facebook. One would have to multiply that cumulative market capitalization by 7.5 times, so between 7 and 8 times, to reach the size of Apple alone. So in my view, it seems that there is an industrial logic to consolidations. Many companies in our sector, even some of the larger companies in our sector, are comparatively small when we look at other sectors. I give the technology sector just as an example, but there are others. So we are in a market, it seems to me, in which bigger means more than it ever has. There still has to be quality, but bigger is better than it used to be. Liquidity is important to investors. And so I recognize that is important, but the challenge is not in that logic, in my view. The challenge is in the premise. The combinations to date are not meaningful, and we've not seen enough, in my view, to show a trend. We've seen certain consolidations, but given the size of the industry, at least in terms of number of companies, it does not appear to me that we've seen enough yet to show a trend. Now, I fully support consolidation. I want to make sure that that's clear. And we've been a participant in smart acquisitions and value creating combinations since our inception in 2003. We acquired 3 companies with assets that were brought into our portfolio in 2006, a corporate business combination in 2007, a comparatively large acquisition, our Canadian Malartic mine in 2014. So we've been proponents, but we put our money where our mouth is in terms of demonstrating that consolidation is important. So I fully support consolidation. We've shown that, but we've not seen enough yet to say to me that we'll see more of it.
Okay. And turning our focus to Yamana specifically, we've obviously seen you refocus on certain core assets and to divest certain of your non-core assets in the recent past. This has obviously helped create a stronger company, a stronger balance sheet in the current market environment. Considering you have plenty of internal growth opportunities, does Yamana need to be active on the M&A front, and is that something that you would look at?
Well, we've gone through periods. I mentioned a moment ago that we've certainly been advocates and proponents and participated in consolidations and acquisitions. There have been periods in this company where we have grown by acquisition, always in context, however, of seeing where we can deliver value added, where we can bring something to bear that improve what we purchased. And by and large, we've been successful in that. But there have been periods where we've been on an organic growth path. And today we're on that organic growth path. We have the assets to support growth. Now, I think we should emphasize, what do we mean by growth? We're not focused only on the top line, the production number. We're focused mostly on cash flow and free cash flow in particular. So even if we were to grow by a certain amount, we're forecasting a production growth in the range of 10% within the intermediate term. We anticipate that will represent more in terms of cash flow growth, and that's important to us. So we want to demonstrate that while there might be top line growth, it is more significant and more relevant to look at what we see the bottom line, which is cash flow and free cash flow. But coming back to point on the organic growth, considering our Jacobina phased, very modest CapEx expansion, Canadian Malartic's underground, the advancement of our Minera Agua Rica project, one of the lowest capital intensity copper gold projects in the world, and our generative exploration program, a program of 7 identified opportunities, 5 in Brazil, 2 in Canada. 2 of those opportunities, 1 Canadian, 1 Brazilian, that already have resources. We have created a production growth plan and a cash flow growth trajectory for immediate, intermediate, and long term. So we would not be adverse to considering external opportunities, so long as they can demonstrate strong returns on invested capital and an accelerated payback. But we're not seeing anything in the market with those characteristics, certainly nothing in the market with characteristics that would surpass the delivery of value and the delivery of returns that come from our organic assets, our internal growth.
Okay. Again, changing tack a little bit and related to your points that you've made on the focus on cash flow. But one of the key objectives of Yamana in the last year or so has been returns to shareholders, with your dividend increasing 3 times in the last year. How important are dividends and other forms of shareholder returns to you? And do you think investors in precious metals miners have seen sufficient returns from gold miners across the sector?
Well, dividends create a discipline on managements to manage their balance sheets effectively. We've paid more than $900 million of dividends since the inception of a dividend, since we declared our first dividend and paid it in early 2007. And while I'm not up on the current statistic, on the current information, last year when we looked at this, it appeared as if none of the other companies in our sector had paid that much within that period of time, from early 2007 to 2019. So we're certainly advocates of dividends. We're paying about $65 million per year in dividends today. We've increased the dividend in the last year as we entered into a period of much improved balance sheet with the generation of free cash flow and increases in cash flows and free cash flows and the sustainability of our operations, operational depth. We came to the conclusion that we could increase our dividend, and we increased it by a full 210% within that period. So now paying roughly $65 million per year. We think dividends are critical, coming back to my point, to show financial discipline on a company. We should be able to, as a company, as an industry, invest in the ground and have money left over to pay a reasonable and sizable dividend to our shareholders. Last year, we adopted a policy, and that policy had multiple components. Let me highlight a couple. One is we don't look at dividends only based on yield to share price or to cash flow. We also look at it in the way that everything else is measured in our industry, which is on a per ounce basis. What are our costs per ounce? So we look at it and say, what's the dividend per ounce? Let's load that sort of as building blocks on top of the cost per ounce to come to the conclusion of what are our margins and what can we afford to pay. We're paying presently $65 per ounce. We've said, as part of that policy announcement, that we wish to pay between $50 per ounce and $100 per ounce. So there's room to grow that dividend, and we think that our cash flows can support it. But one of the interesting things is we've also said that a dividend, to be smart, to demonstrate that a company is investable because of the dividend, we must show the sustainability of that dividend. How does one do that in a world where we are not in control of the price of the metal that we produce? We're not in control of gold price. So we came to the conclusion that the best way to do that is to create a cash reserve. That if we're increasing the dividend to whatever level, then our position should be that we could make it sustainable. And we've said for at least a 3-year period. We looked at that and said, that's a good balance between not having too much cash on our balance sheet and also having enough cash to make it for a period of time that is equivalent to sustainable. 3 years is a decent and reasonable period of time. So sustainability is important. Paying a decent dividend is important. Increasing that dividend is important. All factors that are important to us. One more observation on dividends, and I think it is a comment that is important. It is an observation that is unheralded and should be understood. We also have to distinguish ourselves as an industry and as a company in that industry from gold itself as an investable commodity, as an investable metal. Gold does not deliver a yield. So my view is the way to distinguish between investing in an equity and investing in gold, there are many, but one of those is the dividend. The dividend should be compensatory. It should be compensating investors for the operational risk that inherently exists with a mining company versus investing in gold alone. So for those reasons, that we think the dividends are critical.
Okay. Well, thank you very much. I don't think you got the opportunity to comment on what others and peers are doing in the sector, but I don't think there's many out there that have the capital discipline and the plan in place to ensure that the shareholder returns are maintained, even if the gold price goes down. Unfortunately, we're running very low on time there, Peter. I would have liked to have asked you a question as to your specific gold price forecast for the next year, but I think that'll have to wait until another time. But thank you very much for your time. It's been a fascinating insight, so thanks again.
Well, I would have liked to have answered the question, but we'll keep everyone in suspense until next time. Thank
Great.
you very much.
Thanks a lot.